How to identify high-quality order blocks to trade. Advanced tutorial. Hey guys, welcome back to another episode. In this video, we will teach you how to identify high-quality order blocks to trade that no one ever told you. It is simple to learn and not confusing. So, by the time you finish this video, you'll know exactly when to enter high-probability trade using the best order blocks trading strategy. As usual, we'll have plenty of practical examples. The idea is to fully understand this wonderful trading strategy and to make the most out of it. If you want more videos more often, please smash the like button, subscribe, and turn on the notifications bell so that you know exactly when new content is released. A very important point before we start. Everything we discuss in this video can be used for currency trading, stock trading, and crypto because price action stays relatively consistent across different assets, so we're going to go very in-depth in this video. The most effective way to identify high-probability order blocks for trading. Order blocks play a crucial role in seizing trading opportunities and are widely used by smart forex and stock traders. Unfortunately, many traders struggle to spot valid order blocks with a high win probability, putting their trades at risk. Trading without the ability to identify valid and high-quality order blocks can be very risky and may result in significant losses. In this advanced tutorial, we'll delve into the details of order blocks, explore their different types, and provide a detailed guide on how to identify order blocks with a high win probability. We'll unveil the rules and criteria necessary to recognize high-probability order blocks on real price charts and demonstrate entry and exit models that leverage order blocks in the market. So, if this is something you're interested in, please give this video a thumbs up to show your support and subscribe to our channel if you're new. Let's start our discussion with the main types of order blocks. The first type is standard order blocks. These are the basic type of order blocks that all order block traders should understand really well. As you can see on this chart, in a bearish scenario, standard order blocks refer to the zone that matches the last bullish candle before a sharp and substantial downward movement. The theory behind considering these zones as potential reversal areas is based on the belief that these zones represent manipulation areas formed just before significant market movements. Most big traders view these zones as areas where a large number of buy or sell orders were executed. Therefore, by using these zones in our trading strategy, we potentially take advantage of the likelihood of price reversals and changes in direction when reaching these areas. In this example, we see it after the formation of the last bullish candle. The price experienced a sharp downward movement, leaving significant inefficiency in the market. However, the price eventually retraced to fill the liquidity gap created during the downward movement. As a result, the order block in question was mitigated, indicating that market participants have successfully filled their buy orders. Consequently, the price reversed direction again and continued its downward movement. The second type of order blocks is the wick-based order block. In a bearish market, wick-based order blocks happen when the shadow or wick of the last buying candle or the first bullish candle of the week is larger than half the size of the whole candle. In this pattern, only the candle's wick is considered as the order block, ignoring the candle's body. This method gives us a smaller and optimized zone, compared to considering the entire candle size as our interest area. As you can see here, the price sharply dropped, creating a series of BOS or break of structure that are bearish. So, it's clear that the candle positioned at this extreme point is the first weak bearish candle formed before the price made a sharp downward movement, yet, as you notice, the candle's wick is larger than half the whole candle. As mentioned earlier, we should highlight that the entire wick is our order block, not the entire candle size. Now let's talk about the next type of order blocks. Engulfed order block. In a bearish situation, a bearish engulfed order block happens when an entire bullish candle is completely covered or engulfed by the next candle. This shows strong selling pressure taking over the previous buying momentum, followed by a sudden and significant downward movement. In this example, we notice a shift in the market dynamics as the price breaks below the structure, indicating a change in the previous uptrend's character. The candle we're focusing on is the last bullish candle formed before the bearish movement. Its entire body is covered by the following bearish candle, indicating strong bearish momentum. In this specific case, it's suggested to treat it as an engulfed order block and consider the entire candle as the area of interest. Now, I'll explain the next type of order blocks, called breaker blocks. Breaker blocks are failed order blocks that have been pierced and turned into other supply or demand areas on the chart. When valid order blocks fail to reject prices and the price breaks through, it becomes a level of supply or demand, which we call a breaker block. Breaker blocks are usually most effective when the price breaks through them with a big momentum candle and minimal pullback. Let's look at an example. As you see on this chart, the price was pushed up and broke through these order blocks with a large momentum candle, leaving a significant inefficiency. Then, we can see that the price eventually got pushed back down to fill the inefficiency, and it's also clear that after mitigating the breaker block, the price sharply pushed up. Let's talk about the last type of order blocks, called mid-movement pivot order block. This type refers to candles with different colors, appearing in the middle of a strong upward or downward movement. These candles show a potential reversal signal, indicating a possible change in direction or a temporary break in the current market trend. The idea behind the formation of mid-movement pivot order blocks is that we see this zone as a potential area for a change in direction. Prices tend to turn around and shift direction after reaching this zone. These blocks work as important signals, indicating a chance of losing momentum or a period of consolidation within the ongoing trend. That's why we keep an eye on these zones in the market, as they might signal potential reversals that need special attention. Traders, we've thoroughly discussed the main order blocks that often show up on real price charts. This helps us build a strong understanding of how to spot them. Now, in the next section, we'll explore an entry model to include in our trading plan using order blocks. This entry model will work as an effective tool to execute trades based on insights gained from analyzing order blocks. But before diving into entry setups, it's important to note that I still use indicators to enhance and improve my trading accuracy. I'm a trend-following trader, and my experience shows that trading by following the main market trends is the most profitable. So, here's an extremely effective trading strategy by combining order blocks and indicator analysis that you can apply to all markets and time frames. The indicators we use in this strategy are simple moving average, or SMA, and RSI. The best SMA combination for order blocks is the 200-period SMA, 100-period SMA, and 50-period SMA. These settings are widely used among big traders, automatically making our analysis of order blocks more effective. As for RSI, we use the 8-period RSI because it's moderate and can read market trends and momentum more accurately compared to other RSI settings. However, in this strategy, RSI is only a supporting factor, not the main consideration. So, the next step is to analyze the indicators. First, if the 50-period SMA is above the 100-period SMA and the 100-period SMA is above the 200-period SMA, the market is assumed to be in a strong bullish condition. Conversely, if the 50-period SMA is below the 100-period SMA and the 100-period SMA is below the 200-period SMA, the market is assumed to be in a strong bearish condition. Second, if the 100-period SMA is above the 200-period SMA while the 50-period SMA is below the 100-period SMA or 200-period SMA, the market is in a weak bullish condition. In this strategy, we shouldn't open any positions. Third, conversely, if the 100-period SMA is below the 200-period SMA, while the 50-period SMA is above the 100-period SMA or 200-period SMA, the market is in a weak bearish condition. In this strategy, we also shouldn't open any positions. Rules for the 8-period RSI. If the 8-period RSI is above the level of 50, the market is assumed to be in a bullish condition. If in this condition, the RSI line is facing upward, it's considered a strong bullish market. If the RSI line is facing downward, it's considered a weak bullish market. Second, if the 8-period RSI is below the level of 50, the market is assumed to be in a bearish condition. If in this condition, the RSI line is facing upward, it's considered a weak bearish market. If the RSI line is facing downward, it's considered a strong bearish market. As I mentioned earlier, the RSI analysis is supplementary. The primary focus is on SMA trend analysis, order blocks, and price action entry. Let's switch to a real case in the market. In this chart, we can clearly see the first rule of analysis. The market trend is established. The 50-period simple moving average, or SMA, is below the 100-period SMA, and the 100-period SMA is below the 200-period SMA. So, the market is assumed to be in a strong bearish condition. Here, we can clearly identify an order block formed under the strong bearish zone. Then, the price moves upward for two potential reasons. First, a change in trend to bullish, or second, a market retracement. Because the SMA formation indicates a strong bearish trend, we maintain the assumption that the market is in a strong bearish condition. The upward movement is considered temporary before continuing its bearish trend. As expected, at the order block area, a candle forms a bearish pin bar. This is the best time to enter the market after the bearish pin bar forms perfectly. After the bearish pin bar forms perfectly, we open a sell position on the next candle, placing a stop loss above the long tail pin bar. Since this is a high probability signal, our minimum profit target is twice the risk. This combination of order blocks and indicator analysis offers a high probability of winning because it combines indicators, order blocks, and price action. All analysis techniques are integrated into this strategy. Therefore, it's reasonable why trading techniques like this are heavily relied upon by successful traders. Next, on this chart, we can clearly see the first analysis rule. It's about the established market trend. The 50-period SMA is above the 100-period SMA, and the 100-period SMA is above the 200-period SMA. So, right now, the market is assumed to be in a strong bullish condition. Here, we can clearly observe the formation of an order block that we need to monitor closely because this block is below the strong bullish zone. Then, the price moves downwards for two reasons. First, the trend might change to bearish, or secondly, it could be a market retracement. Since the SMA formation shows strong bullish signs, we continue assuming that the market is strongly bullish and the downward price movement is just a temporary retracement before continuing its bearish trend. As expected, at the order block area, a candle forms a bullish engulfing pattern. This is the best time to enter the market after a perfect bullish engulfing forms. Then, after the bullish engulfing forms perfectly, we open a buy position on the next candle and place a stop loss below the engulfing candle. Because this is a high probability signal, our minimum profit target is twice the risk. As anticipated, the price then rises quickly, giving us maximum profit. Once again, this proves that the combination of order blocks and indicator analysis offers a high probability of winning because it combines indicators, order blocks, and price action. All analysis techniques are integrated into this strategy. Therefore, it's reasonable that trading techniques like this are highly relied upon by successful traders. Now, you've got a great handle on everything about order blocks and high probability trading techniques by combining indicators, order blocks, and price action signals. So, if you want to implement the exact setup shown in this video, you can download all the templates and indicators in the description section below this video. I've included a template with the system that you can simply upload to your chart, and it will automatically plot all these indicators perfectly on your charts, so there's nothing for you to worry about. Get the download link on the description. As always, if you learned something new, or if you want more videos more often, make sure you subscribe, click the notification bell, and share this video across your WhatsApp, Facebook accounts, or Twitter to show your support. See you next time.